what if I told you that while everyone was panicking about a stock crashing 40%, the smartest money on Wall Street was quietly loading up shares? Just 5 days ago, I called SoFi Technologies a generational buying opportunity between $18.50 and $20. Fast forward to today, and that call is already paying off in spectacular fashion. I'm Smart Stock Sam, and in this video, I'm going to walk you through exactly how we identified this massive opportunity, why the recent 7.2% surge is just the beginning, and where this stock is headed next. If you've been following my SoFi analysis series, you already know this has been one of the most accurate calls of 2026 so far. And if you're new here, buckle up, because you're about to see how reading between the lines of market chaos can turn fear into fortune. Let's dive into why SoFi stock is exploding exactly as predicted. Let me take you back 8 days ago to January 31st. SoFi had just reported earnings, and the market's reaction was nothing short of bizarre. Here was a company that delivered its first ever billion-dollar revenue quarter, achieved GAAP profitability for the 9th consecutive quarter in a row, and beat analyst estimates across the board. Revenue came in at $1.01 billion, up nearly 40% year over year, and earnings per share hit 13 cents, crushing expectations. By every fundamental metric, this was a home run quarter. But instead of celebrating, Wall Street threw a tantrum. The stock crashed. Hard. In my January 31st analysis, I identified what I called the SoFi paradox. The stock had fallen from its high of $32.73, yet the actual business was firing on all cylinders. Sure, there was a dilution hangover from a $1.5 billion share offering, and macro uncertainty had everyone on edge. But here's what the panicked sellers were missing. SoFi wasn't just growing, it was transforming. The company had shifted from a traditional lender that relies on expensive credit lines to a vertically integrated fintech powerhouse. Through their ownership of Galileo and Technisys, they eliminated what I call the banking tax, saving them roughly $680 million annually. Even more impressive, 97% of their loans were now funded by member deposits, which cost them 181 basis points less than outside financing. This wasn't just efficiency, this was a complete reimagining of the business model. By February 3rd, just 4 days ago, the selling pressure had intensified dramatically. The stock had surrendered over a third of its rally and was testing its 200-day moving average around $22. In my Rebound Watch analysis that day, I highlighted how the stock was sitting on what I described as a razor's edge. This was a classic battle between operational reality and market psychology. Revenue and profits were climbing sharply upward while the stock price kept sliding down. The disconnect was getting wider by the day, and that's exactly when the smart money starts circling. Interestingly, this was the same day JPMorgan upgraded SoFi to overweight with a $31 price target, confirming that the institutional heavyweights were seeing exactly what we were seeing. Then came February 5th, just 2 days ago, and this is where things got really interesting. The stock had crashed all the way down to approximately $19.46, hitting my target zone of $18.50 to $20. In that analysis, I made my boldest call yet. I labeled this a generational buying opportunity. Why? Because the 40% implosion from the peak of $32.73 had nothing to do with SoFi's performance. External factors were driving the sell-off. Crypto market liquidations were creating forced selling. Delayed economic data was spooking investors. Fear was in the driver's seat, and fear always overreacts. Meanwhile, insiders were doing something fascinating. EVP Eric Schopenhauer bought 5,000 shares at $19.93 on February 5th. General Counsel Robert Lavette scooped up 5,000 shares at $21.04 on February 6th. When executives are buying aggressively during a crash, they're essentially putting up a billboard that says the market has this completely wrong. And here's where my analysis gets validated in real time. On Friday, February 6th, just yesterday, SoFi exploded 7.2% to close at $20.86. From the low of 1946 to 2086, we're already seeing the market correct its massive overreaction. But this wasn't just a random bounce. The smart money that I told you was circling, they arrived in force. Beyond JPMorgan's upgrade, Mizuho maintains an outperform rating at $38. Citigroup has it at $37. The median analyst target is $28. These aren't small-time players throwing darts at a board. These are the institutional heavyweights who move billions of dollars, and they're all saying the same thing. SoFi is massively undervalued. Now let's talk about where we go from here, because the rebound we're seeing is just chapter 1 of this story. SoFi's transformation into a fee-based revenue machine is accelerating. Fee-based revenue hit $443 million in Q4, growing 53% year-over-year. This is crucial because fee income is capital light and high margin. It means SoFi can scale without taking on massive balance sheet risk. They're evolving from a lender into a platform, and platforms command premium valuations. Management just guided for 60 cents in earnings per share and $4.66 billion in revenue for 2026. That represents over 50% EPS growth compared to 2025. But here's the kicker that nobody's talking about: S&P 500 inclusion. SoFi has now cleared the trailing 12-month profitability requirement. They're eligible. A decision could come in the next 30 to 40 days, and when it does, every index fund tracking the S&P will be forced to buy millions of shares. That's not speculation. That's mechanical buying pressure that has to happen. On top of that, SoFi just became the first U.S. national bank to launch its own stablecoin, SoFi USD, on a public blockchain. This isn't just innovation for innovation's sake. They're capturing a younger, tech-savvy demographic that's abandoning traditional banks in droves. While legacy banks are still figuring out mobile apps, SoFi is building the financial infrastructure of the future. So, where does this leave us? The stock is currently trading at a forward PE in the low 30s. As earnings continue to ramp and the company executes on its guidance, that multiple is compressing toward the high teens based on 2028 targets. Translation: you're getting a hyper-growth superstar at value stock multiples. The sentiment-driven meltdown created exactly what I said it would create: a massive arbitrage opportunity between price and value. My calls over the past 8 days identified the bottom with surgical precision, and the market is now beginning to recognize what we saw before everyone else. This is Smart Stock Sam, and if this analysis helped you navigate the SoFi volatility, or if you're just now realizing what you missed, smash that like button and subscribe, because I'll be tracking SoFi's journey to S&P inclusion and beyond. The next few months are going to be wild. Let's capture every moment together.